Folks. So now that most people you would meet, or maybe you yourself, do what is called discretionary investing. Discretionary investing is nothing but, investing with discretion. So what discretion is your choice, the way you want to invest, whenever you want to invest. There are no specific rules in discretionary investing. You met a friend and he or she, advised you on certain stocks and you liked the idea and you bought it. How much you bought it? Uh, at what price did you buy? It's all your discretion. Hence, it is called discretionary investing. So, largely, you can say discretionary investing is non-rule based investing. Now, along with discretion, there comes a lot of regret. The market in general is a regret generation machine, and I'll show you how. There is more chances that you will hit regret than success in your transactions when you are doing a discretionary mode of investing. So let's say you bought at this point, some stock was going up, you buy here, and then immediately on your buying, the stock starts to go down. This is very, very common. You would have experienced this so many times. Then the stock does rise, and then it goes into some sort of range. You decide to hold it there, and then you finally maybe get fed up. Maybe the time period was too long, or some other stocks were running too hard, and you felt that your stock is not doing well, or somebody came and gave you some advice that this sector or this stock may not perform and you sell here. And then the stock jumps very hard. The stock jumps really hard. It goes, multiple of where you bought at, and we have a lot of regret, and you've gone through this. So we need to escape this emotional roller coaster of investing. Investing need not be full of emotions. In general, I would say 99 out of 100 people are investing emotionally in the markets, and those emotions are driving their decisions regarding, buying, selling, holding, etc. Now let's first see the different kinds of regrets the markets puts us through emotionally. So regret number one, we sell anywhere and the stock is likely to go up. So immediately, there is regret. uh, you sold here. Let's say you bought a stock at 40 rupees. It crashed. After a patient losing, you lost 70%, something like that. And this is, for example sake, I'm taking Yes Bank in 2007-8. I mean, it went from 12 rupees to 48 rupees, then back to 12 rupees. Uh, so you sold here, and immediately after you sold, the stock went from 10 rupees to 400 rupees in the next few years. So huge regret, 35 times capital opportunity has been lost. Huge regret, on selling. Things are going up. Next regret is you buy anywhere and the stock is likely to go down. This also, I'm sure you would have experienced in your lifetime. Let's say again, take the same example. The stock is going up. You are skeptical about the stock, but it keeps going up. It keeps going up. The narrative is so confirming. The confirmation bias kicks in. Everybody at a party is talking about this stock. This is going to become the next HDFC Bank. And you say, what the hell? Let me just buy it at 300 also. I missed it at 30. I missed it at 100. I am going to buy it at 300. And you sell your house and, bet on Yes Bank at 300. And then, of course, there's a massive crash of 95% in the next couple of years. Again, huge regret. You bought and virtually the stock crashed. And of course, the fact that the markets continued on while you were stuck and regretting in this particular stock. Regret number three, you sold some stock and the stock actually drops. So, I mean, the probability of this happening itself is very low. But let's say you sold something and the stock actually dropped. But the regret will be, why did you not sell all your stock? Or why did you not short the stock? Right. So let's say again you are at 300, and based on some technicals or some whatever reason that may have ascribed in your discretionary decision, you sold it off at, let's say, 126. Okay, so some part loss you have booked, and the stock actually starts to drop below that level, you are happy that at least on some part you have booked some loss, uh, half a quantity maybe. Now the stock starts to drop and you're happy about that half, but the regret is that why did I not sell all of it here? I could have exited this stock completely, freed my capital even at 50% loss or whatever is the loss, and use that capital opportunistically elsewhere. Now I'm stuck watching this go down, and even if 50% quantity is less, emotionally I'm tied down to the stock. So a lot of times we don't understand the level of uh, emotional stress some losing stocks will give us. Uh, when we buy, we never think about these things. We think about we'll buy at this level, we'll sell at this level. If it comes down, we will do stop loss at this level. This is the standard format. But the experience of that journey, when you actually go through it, is very different. It is not so easy. It is not so simple that you buy at 100 and sell at 200, or you buy at 100 and do stop loss at 80 rupees. It is not so simple. Regret number four. Now, okay, now you buy some stock and the stock actually starts to move up, probability of which is low, but let's say you got that low probability, right? The regret will be, why did I not buy more? Why did I not bet my house on it? I knew this was a great opportunity. I knew that this is a once in a lifetime opportunity. I knew that this is actually going to happen, but my fears caused me to invest only 3% into the stock. I should have invested 50% into the stock, 30%. I like a lot of gurus will say, when you have that conviction, you have to go ahead and bet on it. So similar example again, 2008 crash, stock comes back. Those who are stuck here are getting out. Stocks breaks out. It's a pretty darn positive signal that after a crisis of 80-90%, a stock has come back and is now making new highs. That is a very, very positive sign. But because of this recency bias, you have a fear that it may just do a false breakout and then it may fall back again. So that causes you to buy less. And you only allocate, let's say, 20% of the intended amount. And then, of course, the stock runs up and you say, I really regret not having made this fantastic investment right here. So anything that you are doing in the market on a discretionary basis is a regret. You will blame yourself for buying wrong, for selling wrong, for not buying enough, for not selling enough, because you are the decision maker here, right? So regret multiplies also when it pertains to the downside. This is another very great insight, that if you lose, let's say, $100 or 100 rupees, whatever currency you may have, you will have regret, right? That why did I lose it? I just dropped it out of my pocket. But if you find 100 rupees or $100, or you get it in some sort of, you win it in some lottery, it will give you some joy. The level of joy that you will get by making money or by getting it is much less than the level of regret that you get by losing it. So if you, for instance, losing 100 rupees is not the same as gaining 100 rupees in terms of the intensity of the emotion involved in it. That 100 rupees could be 1 crore also, right? So tomorrow, if your net worth is 1 crore and you lose 1 crore, versus your net worth is 1 crore and you are getting 1 crore, where is the intensity? The intensity is in losing. Gaining is fine. Yes, I made a good bet. I doubled my money. In losing, I made a seemingly good bet, but I lost everything. And my life is destroyed. That is a very intense emotion, right? So how to break this unending cycle of emotional roller coaster is the idea. How to segregate emotions from investing. Investing by itself can be done without this additional burden of an emotional roller coaster. Okay. So have a very clear plan of your investments, and run it like a business. How you are going to approach your investment plan? How much will you allocate to each asset class? How will you, within each asset class, what is the time frame for which you are investing? What is the plan of investing? How are you going to select stocks? How are you going to exit stocks? Who are you going to believe, in terms of, if 10 people are telling you some information, how will you process that? How will you process the changing macro environment in this world? Interest rates going up and down, inflation going up and down, different companies taking market shares at different times, management is changing, um, fund flow, FII flow is going in and out of your stock. How are you going to assimilate everything and come to your decision point? So you need to create a simple magic formula to avoid this so much stress. I mean, investing should be an enjoyable journey. Why should it be a regretful, drab in your life? So a framework that completely eradicates regret and stress in the investment journey is something what we allude to at Weekend Investing. What we say is what to buy. This should be absolutely clear. What to buy. If 10 people are telling me 10 stocks, there should be some framework in which I should be able to put those stocks and say, okay, these are the two I want to buy. Basis some benchmark, basis some rule, right? Now that you know what to buy, you should know when to buy. Anything should not be bought at any time. There are good stocks at bad prices, and there can be bad stocks at good prices. So you need to buy a good stock at a bad price or bad stock at a good price, or have a rule basis which the system will tell you when you need to buy it. Okay. Then how much to buy? A lot of times when we study stocks, we become extremely excited about the stock. We've discovered the undiscovered gem of this world. Nobody else has figured out this lacuna in the balance sheet. I know this company is going to go 100x from here. Everybody else has not read this line in the balance sheet, or has not heard this statement from the management, or has not done this plant visit, which I have done. And I am going to bet my house on it. Right? This feeling comes a lot of times. Sometimes you are having the products of that company, and you really, let's say a FMCG company, you are eating the biscuits of that company. You really enjoy it. Said what a great product and what a great company. This is going to go blockbuster, right? So these are the self-assertive, self-affirmation kind of biases that we get, and we tend to overestimate, how much we should be buying. So how much to buy is very, very critical. In a non-discretionary method, maybe you will go with some rules that I'm not going to exceed 5% of my portfolio into any one stock, however much I may like that stock, right? So how much to buy is very, very important. While there are stories of concentration where somebody bought two stocks and those stocks become, crazy multi-baggers over the next 10 years, there are billions of stories where people bought concentrated stocks and were destroyed. So it is your choice who you want to believe. Success stories always shine out. Failure stories, nobody will tell you, right? When to sell, the most important of it all. You know what to buy, you know when to buy, you know how much to buy. Now you've bought, you are gaining big. Now when to sell? Am I married for life to this stock? The biggest mistake one can do actually. Most stocks, barring exceptions again, I mean, in the world of, let's say, 7,000 stocks that we are seeing in the Indian market, or a few thousand stocks in the US markets, there may be a few stocks that have just continued to go up. But those are exceptions. Those are not the norm. That is not the rule. Most stocks will go up. Most stocks will also fall down. Most stocks will have a pole position in their industry at times, then they will give it up. Most stocks will go through a change of management. Most stocks will go through a restructuring of maybe their debt. Uh, so there is a cyclicality to the performance of the stock. So you need to sell at some point. At least you need to know when to sell. That framework, that paradigm needs to be set, that I know if this happens, then I'm getting out. Let's say, even if I'm saying you are not technically or price behavior oriented and you are doing a fundamental based analysis, and you are saying last 10 years, my return on equity is so much, or the margin, the net margins are so much, then you need to create rules that if my margins drop below this much, if market share drops below this much, if this happens, then I need to get out. Then If I don't get out even at that point of time, then what is going to, uh, you know, uh, sort of convince me to get out at some point? Usually that is complete desperation. Stock has gone from 100 to 20 rupees. Everybody is saying this stock is finished. That is when most people sell. That I am unable to, make any kind of future projection for this particular stock, and everybody is saying sell, sell, sell. So I can't really help it now. My brain has gone dead. Let me sell it now. And that is usually the bottom or the lowest point of that stock to sell. So exit rules, when to sell, is very important. You need to know that selling can be done in profit and selling can be done in loss also. Both are important. If my stock has gone from 100 to 500 and now wants to come down, I'm happy to sell it at 400 also, even if I've lost the top 20%. If my stock is going from 100, then while it is on that path, I'm happy to get out at 80 also, and get my capital into some other opportunity. So the absolute crux is this of a non-discretionary system, that you need to be extremely fixated about a framework. You need to set your brain aside and run as a military like fashion behind these rules that you've set for yourself. And of course, these rules need to be well thought out, well tested, uh, and need to be practical. And momentum investing, the way like we do it at Weekend Investing, is one shining example of that. We basically follow these rules for all strategies, and we don't do any discretion. So this, I hope, will make you learn the importance of a non-discretionary system. More and more people, as you would see, and some institutional funds also are moving towards this direction. There are some quantitative based systems, a lot of algorithms are running. This is all because human emotion is subject to failure, and this is the financial part of your life, your investments. There is no sort of, you can't help having a failure there. And that is exactly why you need to depend upon a non-discretionary system. Thanks. Bye.